Okay, thank you, everyone. So today we're going to talk about taxation of employment income. So, and of course, as per this particular unit, which is business taxation, we are going to look at taxation of various income to narrow down to employment income. I am yours, Dr. Justin I.GACHIGO. So now, uh, by the end of this particular class, I would expect all of us to be able to define the term employment income, to understand the process of employment income, to understand how to compute the taxation of an employee, and even other things, filing, and whose obligation is to file, and an employee has an obligation toward the filing. All right, let us jump very fast to the introduction. So what is employment income? So employment income, and I believe all of us, if not all of us, the majority of us are already in active employment. So when we talk about employment income, it is all the monetary resources or non-monetary benefit that you receive in the respect to the services that you render to your employer. So you are employed as a cashier, you are employed as a bank teller, you are employed as an accountant. So you normally receive at the end of the month a basic salary. So you go to the bank and you withdraw some money. So that is employment income. Sometimes your employer may pay for you a cab. That is employment income. Your employer may give you some lunch. You may be given some air. You may be given some passages. You may be given overtime. All those, anything, any benefit that from your employer, that is what we refer to as employment income. Now, the source of income is determined by the residential status of the employee and whether he was and where he was recruited. So when you talk about the concept of resident, it's a very broad topic out with in a better way from the international taxation. But primarily from this uh, definition, the residential status, it's either you are a resident or you are an non-resident. For example, if you are Kenyan by birth, you are a resident. You can also be a resident by registration or other method which are provided by the law that you can become a resident of Kenya. A non-resident may be somebody who has been here by a work permit or by a visit visa or any other arrangement, but you have not achieved or attained the full residential status. So now, when you talk about the taxation, now the taxman look at it from this angle. Now, is the income that you are earning derived from Kenya? Are you recruited from Kenya or are you from Kenya? So if that meets, then it means that your income is going to be Kenya. So in Kenya, a resident employee, it is taxed on employment income and from any place in the world, so long as he was recruited in Kenya by a resident employer or a permanent establishment in Kenya for a non-resident company. So that is to say, now, if let's say you are not a Kenyan, yeah, you are not a Kenyan, but for the tax purpose, say you work for a company called Google. Google is in Kenya, but country. So your payroll is processed by a company that is in Kenya. That means the company in Kenya must remit your tax to the Kenya Revenue Authority, regardless of whether you are a resident or not a resident. But you are working for a company with a permanent establishment here in Kenya, or by a resident company in Kenya. So who is an employer? So for the taxation purposes, an employer is taken when necessary to include one, any person having the control of payment of remuneration of another. So the employer has a control on your payment. So when you are signing the employment contract, the employer said, I will give you 50,000. So that means he has a control. That is the limit that you can gain from your employment. And any agent, manager, or other representative in Kenya of any employer who is outside Kenya, any paying officer of the government or other public authority, any trustee, insurance company, or any other body paying pension. So that is to mean any person who is making remuneration or giving money, which is from gainful employment, is regarded as an employer. And one thing you come to notice is that the definition from the tax and the dictionary may differ. So who is an employee? This word is defined as inclusive of any holder of an appointment of office, whether public or otherwise, for which remuneration is payable. So you are a holder of an office and payment is done, and that means you are an employee. Employee should be led as including, for example, ministers, chiefs, any public servant, company director, secretary, etc. It includes an employee who retire on pension and stay in Kenya, where the registered pension fund benefits exceed Kenya shillings 180 per annum. So those are employees that we have as per our Income Tax Act. Now, let us look at the gains. So the gain from employment or service rendered will include both cash and non-cash. So for cash benefits, this is what of us we know. There is wages, salaries, leave pay, sick pay, payment in lieu of notice, director's fee, and other fees, overtime, commission, bonuses, gratuity, or pension, whether payable monthly or at a longer or short intervals. Then we have the cash allowances, including house allowance, rent, telephone, loud sum allowances. There's a repetition there. Have the amount of any private expenditure of the employee paid by the employer, otherwise than as loans. So sometimes the employer may pay some expenditure on behalf of the employee, like electricity, water, telephone bills, school fees, etc. Then we have excess per diem. So the current out of the workstation, for example, you work in Chuka County, but your employer sends you to Mombasa County. So you are allowed to be given an allowance of or per diem of 10,000 per day. So if it exceeds 10,000, then it's going to be taxable. Initially, or I think it was 3,600, but this one was increased to 10,000 to conform to the current economic situation. Because, for example, you go to Mombasa, maybe in a simple Airbnb, the cost is around 5,500. Then the food and the rights. So you may find that 10,000 may not even be sufficient. Some employees assistant, traveling allowance, entertainment allowance, etc., etc. All these cash benefits, they are normally added to your gross or basic salary taxed. So there is a statement here. However, if the commissioner is satisfied that such allowances is a reimbursement for expenses actually incurred by the employee wholly and exclusively in the performance of the duty, then the amount is not taxable. It is excluded from the or profit. So in some cases, you find that these subsistence allowances, like traveling, let's say you are given 5,000 to travel to Mombasa, and you travel to Mombasa by Guardian Age bus. You get a receipt to Mombasa 2,500, back to Nairobi 2,500. That is 5,000. So you have provided an evidence that this amount, you use that amount for traveling purposes only. You do not benefit from that amount. Maybe you paid 1,000 to Mombasa and another 1,000 to Nairobi, then you saved 3,000. If you can be able to provide evidence that you indeed used the whole amount traveling to perform the duty that you trusted by your employer, then that is not going to be similar to the entertainment. You have been given some money to go and do client entertainment. And the whole amount that you have been given, you have been able to account for that amount in total or in full. Again, that amount is not going to be added back to your employment income. Then we have tax-free remuneration. These are instances where employee negotiate their salary of taxes. For example, you go and tell your employer that for me, give me 100 Kenya shillings net. So the other, it is going to be borne as a burden by the so the tax so paid by the employer for the employee become benefit chargeable to tax. Then we have the concept of the non-cash benefits. So non-cash benefits, we have the benefit in kind, for example, free transport, gift to employee, free meal. So this, when aggregated, 5,000. If they exceed 5,000, then the difference can be taxed. And there was a continuous issue where, for example, in the evening, you are given a cab by the employer. Yeah. So if you are given a benefit should not exceed 5,000 per month. If it exceed, then this one can be taxed. But in most cases, the employer normally bore this in terms of the P&L. Servant quota, again, this is taxable. It is the higher of between the market cost and the actual cost incurred by the employer. For example, if you have been given a cook, watchman, a gardener, a maid, a bodyguard, a messenger, a chauffeur, etc. So this one, the tax amount, it is the higher of the market cost. For example, let's say the market cost of one guard is 5,000 and you are paying 10,000. So the higher of, it is now the actual cost, which is higher, that is going to be added back into your payslip and be taxed accordingly. Then we have this provision of services. If it's electricity from a communal or from a generator, this is taxed at 1,500. If it is water communal or from borehole, this is 5,500. If it is electricity, these are for agriculture. For agriculture, it is at a reduced rate of 900 and 200. Then for motor vehicles, from 1st January 1996, taxation of a motor vehicle is based on the greater of one, the commissioner quantified benefit based on CC rating, or a percentage of the initial cost of the motor vehicle. That is 2% per annum or 24% per, sorry, it is 2% per month. This one should be 2% per month or 24% per annum. So these are the commissioner's prescribed rate. So for example, if it's a car up to 1,200 cc, this is the monthly amount. These are the annual rates. Then we have all the Land Rover. You have the monthly rate is 7,200 and the annual is 86,400. So these are the amounts which are prescribed by the commissioner. So it is the higher of now this amount or 2% of the value of the car. So it is 2% of the initial cost of the car or this amount which are given here. Then we have a housing or quota benefit. So the housing benefit arises where an employee is housed by his employer in a house either owned by the employer or the employer pay rent directly on account of a house occupied by the employee. So to of the housing benefit that accrue to an employee, employees are classified into the following categories. Category 1, we have ordinary. So in this case, the housing benefit shall be taken to be 15% of employment income, that is cash plus non-cash benefits, less nominal rent paid by the employee toward the house. So if you are an ordinary employee, your house benefit will be either it will be the higher of 15% of your employment income. So you get the cash plus non-cash benefit, you get 15% out of that. Then less nominal rent paid by the employee. So less what you are actually paying. Let's say, for example, the 15% of your employment income is 50,000, but the house that you stay, you normally pay 1,000. The difference between 50,000 and that 1,000 is 20,000. 20,000 is the amount that's going to be taxed. Then we have the next category. These are the agricultural employee, including whole-time service directors. An agricultural employee is one whose term and condition of employment require that he resides within a plantation or a farm. For example, those workers or managers or directors who are working at a farm like what do we call this farm in Dhaka? Del Monte, yeah, or the BAT farms, the sorghum farm for East African breweries. So these are the ones who are agricultural employee. So for this case, the housing benefit shall be 10% employment income. So instead of 15%, here it is now the 10%. Now we have employee earning over 50,000 per month, and it's from 1st January 1995, where an employee earns income in excess of 50,000 per month, that is 600,000 per annum. The housing benefit shall be greater of the market rent value of the house and the computed housing benefit based on the type of employee. So employee provided with a meal, with a housing and free meal, where an employee is accommodated within the hotel premises and takes his meal there, the value of the benefit shall be 10% of the accommodation and to cover meal, giving a total of 20% of employment income. So again, for example, maybe for some reason, you may be given accommodation by your employer that you stay in a hotel. In that hotel, that's where you are going to be taking meals. Hotel, that's where you're going to be having accommodation. So if that is the case, you find that it is 10% of the cost that is paid to the hotel as accommodation, and 10% that covers the meal. So that will sum up to 20% of the employment income. Then we have this whole-time service director. This means a director of a company who is required to devote substantially the whole of his time to the service of that company in a managerial or technical capacity, and is not the beneficial owner of or able, either directly or through the medium of other companies or by any other means, to control more than 5% of the shares or the voting power of that company. So that is what we refer to as whole-time service director. A whole-time service director, you don't owe shares in a company, or you owe less than 5% of shares, and you spend most of your time there. So now for this whole-time, the housing benefit is 15% of the employment income, provided if the employee pay rent under an agreement not with that party, the value of the quarter shall be the fair market rent value of the premises in that year, or rent paid by the employer, whichever is greater. So for the case of a whole-time service director, if you are given housing by your employer, the taxable amount will be the higher of if it is not at the arm's length. Arm's length means if you are given a rent, if you are given an employer, yeah, let's say you are given if the employer pay rent at an agreement not made at arm's length with the third party. So the employer pay, but let's say you are living in a house of 50,000. 50,000, that's the rent that is being paid. But now the house, maybe for example, it is worth 70,000. That is the arm's length. The arm's length means the price that anyone who is not known by the third party will pay. If you go to ask for a house in a specific area, you are told by the landlord that here we charge 70,000. But for this case, maybe they are given a rate of 50,000 or even higher. So if the employer pay rent at an agreement not made at arm's length with that party, the value of the quota shall be the rent value. So the taxman will look at the rent paid and the fair market value. If, for example, you are paying 50,000 for the rent, but the actual is 70,000, the taxable benefit will be 70,000 and not the actual amount which is being paid. So the taxman will look at the higher. So where the premises are owned by employer, now in this case, the fair market value of the premises shall be the taxable benefit. So if, for example, you are employed by and let's say Chuka University has some staff quarters. So the benefit will be that staff quarter, how much will it be worth by any other person apart from you as an employee of the Chuka University. If, for example, the rent market value of that area is 70,000, that 70,000 is going to be the tax benefit. So then we have the director, other than whole-time service director, and in this case, the housing benefit shall be 15% of the total income, provided that if the employer pay rent at an agreement that is not made at arm's length with that party, the value of the quota shall be the fair market rent of value of the premise in that year, or the rent paid by the employer, whichever is greater. So this is the same concept that we just discussed from the whole-time service director. Where the premises are owned by the employer, the fair market rent value of the house shall be taxed. Again, we have also discussed this concept in the case of the whole-time service director. Note, the fair market rent value shall be taken to mean the amount of rent that the premises would attract if it were floated in an open market. Fair market value, it is the price that any Tom, Dick, and Harry will pay, as opposed to someone who is known. And in this case, an independent registered valuer should carry out the valuation. So it's not your work. You are not an expert in valuation. So it is a registered valuer who will come and do the assessment. So additional notes, where an employer provides an employee with a house for only part of the year, the housing benefit shall be reduced proportionately to a period of the occupation. Let's say the year is made up of 12 months. So if the employer gives you the house for 6 months, so the benefit will be on pro rata basis. Let's say if it's 6 months, it will be 6 over 12. Where an employee pay nominal rent toward a house provided by an employer, such amount will be deducted against the housing benefit. So if where an employee pay nominal rent, so if an employee pays nominal rent is the actual amount. So let's say if an employer give you 40,000 and you pay 40,000, so that is the benefit you are going to gain, and it will be deducted against the housing benefit. Where an employee occupy only part of the house provided by an employer, the housing benefit shall be computed on the basis which the commissioner think repeatable. So if you are given a house but you don't occupy the whole house, again, this is now the commissioner who may come up with an equation, although this one it's a gray area. Then there are some exceptional cases. So there are certain instances that would provide a strong case for employees not to be taxed on the benefit of a house provided by the employer, and this include where a house is provided as a basis for effective performance of the duties of an employee. An example, we have the caretaker who may be given a house by by a landlord. So the caretaker cannot be charged. This one is a benefit because this is for his effective performance. So we have another case where house of necessity to an employee proximity to their work, e.g. a matron of a school or a captain of a ship. So again, this one is going to be an exception to a house benefit. It's not a benefit as per se. It is a tool of work where an employee is under a form of threat or where accommodation is part of security detail, e.g. occupation of a soldier within the barrack, housing provided to researchers in undisclosed less. So these are necessary for their work. Then let us look at the low interest or interest-free loan benefit. So what happens when your employer gives you a loan? So when an employer provides a loan to an employee or a relative of an employee and charges interest, which is below the commissioner's prescribed rate of interest, then the difference between the prescribed and employer's rate shall be taken as a benefit. So if you are given a free loan, for example, say you are given loan at a 0% rate by your employer. So now the commissioner will look at it. What's the difference between the commissioner prescribed rates? So commissioner prescribed rates, these are actually these rates are normally published at KRA website. So you see the rate which the commissioner prescribed. So the value of the benefit will be the rate that you are given and what the commissioner prescribed. So let's say the prescribed rate by commissioner is 15%, and your employer gives you at 0%. So in this case, you're going to pay 15 minus 0, which is 15%. If, for example, your employer charges you 10%, then again it will be the difference. So this is also known as fringe benefit, and the employer, not the employee. So for the fringe benefit tax, in most cases, it is taxed on the employer, not on the employee. Then you have passages to expatriate staff. When an employer himself pay for reimbursement, the cost of passages, including leave passages for his employee and family, the value of the passage is non-taxable benefit of the employee provided the employee is recruited outside Kenya, the employee is in Kenya solely for the purpose of serving his employer, and the employee is not a citizen. So this passage to expatriate are people who come, for example, you are not a resident of Kenya. Yeah. So if you are recruited outside Kenya, let's say you are from South Africa and you have come to Kenya, yeah. So those passages they are not going to be taxed on you. They are going to be reimbursement. Where, however, such employee receive cash, either periodically or one amount which is free to save or spend as he chooses, or for any other purpose, and for the expenditure of which he does not have to account to the employer, the amount received is a taxable cash allowance. So in some cases, you find that this money you are free to use how given the money. So you can say to save this amount as opposed to spending them on air, yeah, or for the purpose which it was designed for. So in this case, that amount is going to be allowance. So we have non-taxable benefits, for example, medical services and medical insurance. These are not taxable, but again, these medical services or medical insurance be discriminatory. It should be offered to all employees. So for the directors, or the limit is currently it's 1 million per year, and the medical insurance must be provided by a provider who is approved by the Commissioner of Insurance. Then we have contribution to a registered or unregistered pension scheme. For example, we can have your employer, he pays to Zamala. Zamala is a registered pension scheme, or Britam, or CIC, or ICLion, or any other insurance company which has a pension scheme. the current amount is 30,000 per month. 30,000 per month is not taxable, or 360 per month per annum is not taxable. Initially, this was 24,000 per month, which was equivalent to, I think it's about 240 per year. This was revised by, I think, Finance Act 2025. Then we have a staff meal provided to low-income employee. This again is tax-free. And a low-income employee is defined as an employee whose marginal rate of tax on income does not exceed the rate of 20%. So if you look at the tax bracket, an employee who is or does not exceed it is below the third bracket or the third band, 1,333. That is a low income employee. And if they are given meal, then those meals are not taxed. Free meal offered through income employee by employer within his premises. Again, this meal should be offered within the employer's premises. Education, again, this is not a taxable benefit. That is a school fees paid by the employee, paid education fee paid by the employee, the dependent. Then we have allowable deductions from the employment income. So we have talked about the so the pension to registered pension scheme, it is normally the higher of the deductible amount is less of, not higher, it's the rest of actual amount contributed by employee. So you look at the actual amount that is contributed by the employee, then or 30% of the employment or pensionable income, which means that is all the emoluments subject to pay and CDT ceiling. That's the Commissioner of Domestic Tax ceiling, or the actual amount or the prescribed amount by T is not 1,000. So you're going to look at those three criteria. The amount that is deductible or allowable, it will be the higher of, it will be the lower of. Remember, when the commissioner is looking at the allowances, that is the relief. They don't take the higher. When the commissioner wants to charge you tax, they look at the higher. When they are giving you relief, they look at the lower of. So here, because you are being given a relief, so it's going to be the lower of, the lesser or the lesser of, either the actual, let's say the actual amount is that 1,000, then the actual amount that is paid, then we have, or 30% of your employment income. So let's say that percent of your employment income is 20,000, or the prescribed amount by the domestic taxes, which is 30,000. So you're going to take the lesser of the three, and that is what is going to be allowable. So you're going to see this one practically. Then we have the registered home ownership saving plan. So for this plan, you find that the amount that is allowable per year is 80,000, and this amount is, and you are supposed to enjoy this amount for a period of 10 years. So 10 years is the limit. Then we have NSSF. Again, for NSSF, contributed to NSSF, again subject to the 30,000 per month or 360,000 per annum, because NSSF and other pension schemes, they are grouped together. So the amount should not exceed this amount. Then we have the buyer interest or mortgage. So for the mortgage, this is normally, this is the interest paid from approved mortgage house, from the approved mortgage, from approved financial institution, like let's say the housing finance. The benefit of the interest, the amount which is deductible from tax is 35,000 or 300,000 per annum. But you have to prove that the amount or the facility that you took, it is to purchase the premises, or to improve the premises. But note, the amount is not on the principal. It is on the interest that you normally pay. Let's say you took a mortgage of 100,000. So this mortgage of 100,000 per month, you are paying a total of 100,000 per month. Out of the 100,000, 50,000 and 50,000 is interest. So you pay the deductible amount is on the interest. So if it is 50,000, so you're going to enjoy 1,000, which will be tax free. So then we have the reliefs. So the government normally gives reliefs to employees or the people who are from gainful employment, normally 2,400 per month or 28,800. Then you have insurance relief. So if you have taken an insurance cover, the relief is 15 of the premium paid, subject to a maximum relief of 5,000. You have a life insurance cover. So you're supposed to claim a deduction in your payroll of 5,000 per month, or 60,000 per annum. So you should be able to you're supposed to disclose this information to your employer so that they can be able to give you that relief at the end of the year. So now we have a here. So this practical question is just a follow-up of the theory that we have just discussed. So we are going to go through this question together. Mr. Daniel Kipto, an employee of Rafiki Manufacturing Limited, with the following information relating to his employment for the year ended 31st December 2024. His basic salary is Kenya shillings 300,000 per month. His employer provide a furnished housing for which the company pay rent of Kenya shillings 80,000 per month. The employer also provide domestic servant as follows: a gardener earning Kenya shillings 15,000 per month, a house help earning Kenya shillings 18,000 per month. He received a bonus of Kenya shillings 150 in December 2024. The employer provides him with a company car with a capacity of 2,000 cc, which is 2.4 million. The car is available for both official and private use. That's a very important information. The company pay his life insurance premium of Kenya shillings 10,000 per month. The employer contribute Kenya shillings 25,000 per month to a registered pension scheme, while Daniel contribute Kenya shillings 15 per month to the same scheme. During the year, the company give him a long service award worth Kenya shillings 50,000 and a gift voucher worth Kenya shillings 12,000 for his birthday. The employer provide free lunch at the staff canteen valued at Kenya shillings 4,000 per month. Daniel took a loan of Kenya shillings uh, 2 million from the employer at an interest rate of 5% per annum. The market rate the commissioner during the year was 10% per annum. 10 pay of that was deducted during the year. Additional information. Personal is 2,400. Pension contribution you're given is the lower of okay, this information is not updated because it should be 20,000. It should be that 1,000 currently. The benefit rate for the motor vehicle. So this it is 2,000 cc and below, which is of the vehicle cost. The value of the house benefit is higher of 15% employee gross pay, actual rent paid, and fair market value. So you are required to compute total taxable employment income. So what is the taxable employment income? So taxable employment income, it is the basic salary plus all other benefits, but less, remember less the deductions. So we have seen the deductions. We are going to compute those deductions. Then finally, compute the tax payable, showing pay due or refundable. Remember, you have been told that a pay of 1,050,000 was deducted during the year. So let us do the calculation. So the basic salary, 1,000, you multiply by 12. So he earns 3.6 in a year, and been given that he is given a bonus of 150. Then he is being given a house, and we said the housing benefit, it is a higher of 15% of the basic salary, which is the 140, to market rate paid by the employer. So employer 60. So you take the higher. Remember, for amount that we add back, or the amount which is not allowable, or the amount which are treated as a benefit, it is the higher of the two, which is 960. Domestic servant, you add the two, you get that. Domestic servant, we say it's the higher of what has been paid or the market rate. So this is what has been paid. That's what we have actually been given. Then the car benefit, it is 2% times 2.4 times 12. You get that. Insurance premium, which is paid by the employer. Remember, this is a benefit, 120. Long service award, again, this is a benefit, 50,000. Gift voucher, birthday, this is a taxable fridge benefit, 12,000. Lunch, this is exempt because it is from the staff canteen. The low interest, remember we said it is the difference between the commissioner prescribed rate and the actual rate. So it is 5% times the amount, which is 100,000. So the gross or total employment income give 5.9. Then here you need to deduct the pension. So the pension, we said, is the lower of, remember these are the deductions. Now you should less. It is the lower of 1,000. So this is not updated because the current finance act, should be 1,000. So it would be the lower of 160. The actual, so the actual is 180. So you raise 180. So you get net taxable employment income should be this minus 1, which is that amount there. Then these are the tax band. So where you say the first this amount is taxed at 10%, which is that. The second one is 35, which is that. The next one is at that, which is that. So you get the gross total taxes. You get from the first band, second band, and the third band, which is that amount there. Then less personal relief. Personal relief is this amount here, which we have discussed. So the next pay payable is the gross pay tax minus the relief, which is 16. And remember, the amount that was deducted was this. So the balance due to employee will be 1.6, which is computed, minus what was deducted, which is 593. So the employee should pay that amount to the revenue authority. So now, to test this will be our assignment number 1. So which should be, which you should work on it and hand over by next week. Thank you all and have a good evening.